Good afternoon, everyone. I'm Madhu Apisa from Alraji Capital, and I welcome you all to Jamjoom's Q2 2024 earnings conference call. From the management, we have Dr. Tariq, the CEO, Mr. Anwar, the CFO, and Mr. Mohammed, Head of Investor Relations. As usual, we'll be having a presentation followed by a Q&A session at the end. Without any further delay, I'll hand over the mic to Mr. Mohammed to start the proceedings. Mr. Mohammed, the floor is yours. Please go ahead.
Assalamu alaikum and good afternoon to everyone joining us today. I'm Mohammed bin Khalid. This session will be a 1-hour call with about 20 to 25 minutes of presentation, after which we will open the floor for a Q&A session. I will now hand over to Dr. Tariq, the CEO, for the presentation.
Thank you, Mohammed, and thank you all for attending the call as always. Let me start by just a brief statement that I'm pleased that our results year to date for the first 6 months of 2024 is basically as phenomenal and as positive as what we presented to you almost over the last 12 quarters or so. So I'm pleased with the progress of the company and the quarter on quarter, month on month delivering on the results. And let me share with you the highlights of this. So if we can move into the first slide, Mohammed. Okay, so basically this is a quick snapshot on our key financials, starting by revenue. The revenue of the first 6 months of 2024 landed at 731. A number that is very close, by the way. Let me draw your kind attention to our full year revenue delivering on 2021. So you can see that in the first 6 months of 2024, we are almost delivering the full year results of 2021, which was exact number was 736. So very pleased with this and the development on the business and the progress that the team keep on driving months after months, quarter after quarter, and year on year. Basically, 2024 first 6 months reflected from a revenue generation point of view 22% growth. And from an EBITDA perspective, we delivered 27% year on year with a margin of 35%, which is again phenomenal results in my humble view. Net margin or net profit for the first 6 months, along with earning per share, a very strong 23% growth, matching the growth on revenue. And basically, really, Jamjoom Pharma continue to track with the same way that big pharma and multinationals operate, not only similar to how the generic or the branded generics operate from a margin perspective. Our free cash convert or free cash flow continue to impress at 86% conversion rate. Our capex remain at our guidance of we always promise 4 to 6% of top line, and it's soft landing at 5% in the first 6 months. The free cash convert is growing at 21% year on year. The unit produced out of our fully functional 4 facilities at the moment is basically 24% growth year on year, which matches the more or less or exceeds a little bit the growth on revenue. And we managed to really in the first 6 months of the year launch 7-8 products between the consumer health and the pharma. Remember, I always told you that since we re-engineered our strategic direction, we said that we are going to launch 6 to 10, maximum 12 quality launches every year, and we're tracking well in the first 6 months. Next slide, please. Yeah, so that's a quick snapshot again on the slide that I share with you on quarter by quarter. discussing our strategic levers for 2024. So basically, when it comes to our inception market, Saudi Arabia, we continue to track well in expanding in tenders, and I'm going to give you a quick snapshot on this in a slide or two. The private market growth continue to match/exceed the overall market growth, despite certain amazing dynamics that is happening in the market. That again, I'm going to draw some light on in a second. Then we continue to really use our market access abilities into driving Wasfati and other insurance business for Jamjoom to become really a key beneficiary, or perhaps the best beneficiary out of this evolving market segments that are driving the growth of the market at the moment. When it comes to our other export markets outside Saudi Arabia, we continue to solidify our presence in places like Gulf and Iraq, and I'm going to share with you in a second the amazing growth that we are driving in such markets. Our consumer health continue to impress as well, with very strong business participation in the inception market in Saudi, and good early signs in taking it beyond Saudi Arabia into Iraq and the Gulf as well. And then we continue really to look at other opportunities within export markets. What are the key active markets that we need to add into our existing active ones at the moment? From a portfolio diversification point of view, definitely the focus on consumer health, which is a key differentiating factor at the moment. So because we're a pharma plus company, we're not just a branded generic pharma organization leading the Saudi market, but we have the consumer health, which really adds a plus on the diversification of our portfolio, and perform very well almost in every category. We are number one or in number two. And remember, this is a very young business in terms of us driving this business over the last 3 years, from a very modest business contributor into one of the key business contributors for Jamjoom Pharma in Saudi, and hopefully outside Saudi in the coming few years. We continue to utilize our new trial facility in Saudi Arabia now that we got it fully operational, and we started to get product approvals to go commercial as well out of this. Very pleased with such involvement, because it will really address a key gap in the demand created on the ophthalmic products, and our ability from a capacity constraint perspective to deliver on this. So I look forward to this facility to really add into our growth going forward. We continue as well to ramp up our Egyptian facility, and today, as we speak, almost 60% of the local needs, and I mean by local, the Egyptian market, is satisfied through the local facility. And toward the end of the year, perhaps this number will meet or exceed the 70% targets that we set for this facility in the first full operational year. We continue to really drive strongly our business development initiatives, trying to tap in and into other key products lines that we believe will complement the growth drivers for Jamjoom Pharma as we move forward. Coming slide. Yeah. So some quick snapshots on highlights from how these markets are evolving. Saudi, for example, I told you last quarter, and it's actually happening even stronger this quarter. And for the first 6 months, we are seeing the lifestyle products, the likes of the injectable type 2 diabetic products from Eli Lilly and others, are really driving the market and taking this market by surprise. Imagine that this product today constitute almost 90% of Eli Lilly sales, and it's driving them into some months becoming number one player in the retail market in Saudi Arabia. So this lifestyle products is really taking the market by surprise and contributing heavily. So as you can see in the first bullet point on this slide, while the overall market has grown by 17% almost so far, 8% out of this growth is coming, or 9% is coming out of these lifestyle products. So the actual market growth, excluding these anti-diabetic products, is 8%. So it's almost doubling the market growth from a couple of products that are taking the market by surprise. Our own business, when it comes to retail, is growing very well. As you can see, if we take the market growth at 8%, our growth in the retail is 16%, and even more solid growth when it comes to the tender business at 18%. You know, I always told you that we'll try to drive the tender business growth at a higher pace than the retail, so that we can catch up with the lost opportunities that we had in this fast-growing segment, the institution and the governmental sector. Wasfati, on the other hand, again, it's still driving very strong growth. So the overall Wasfati business has grown in the first 6 months by almost 37%. We grow almost double this at 64%, our share of business that's coming out of Wasfati. And that's up to end of June. Within our export markets, basically, we for the first time get the 8th rank in Iraq. And I'm very pleased with the growth that we are driving in this market this year. We continue to gain share in the Gulf as well, with 21% growth for the first 6 months. Egypt, we managed to get, after a very heavy round of negotiations with the government officials, we got few products to be repriced, and we got some good price increases that can partially offset the impact of devaluation, not fully, obviously, but something definitely better than where we were before. In terms of portfolio, we continue to drive our cardiometabolic. We continue to launch other anti-diabetic products into the marketplace, and it continued to outperform the market. We'll speak about manufacturing again in a minute. And I told you about the fact that in Algeria, when it comes to our future initiatives, we would like, now that we bought a plant for oral solids, we would like to get into ophthalmics and dermatological. And so our initiatives to build an ophthalmic facility is up and running there, and we got certain advancements in this. We continue to drive negotiations for toll manufacturing of some big pharma products through our facility in Saudi and Egypt. I'll tell you more about this once we finalize the deals. And we have really advanced the discussions with certain parties for strategic partnership on some of the key products that can complement our portfolio. Next slide. Yeah, so when it comes to the facilities, as I told you, I'm pleased. That's why you don't see timelines on the bottom half of the slide, because all the plants are now fully operational, so we don't have an expected time for them to become operational. Different pace, obviously. Egypt, we are almost at 10 million unit produced so far. Algeria, 4.5, and the newly joined one, which is a new sterile facility, almost at 2 million unit produced so far, and one product approved to go commercial, while we expect another 2 or 3 approvals before the end of this year. Next slide. Yeah, so that's a slide which is close to my heart, and I'm very pleased to share with you our progress, not only on a category by category business perspective, driving the growth, but as well market by market. Remember, we always said that we'll continue to grow ophthalmology and dermatology, but certain other category perhaps will grow at a higher pace, so that we diversify the business in the right manner. And when it comes to markets, Saudi will continue to grow, and we will solidify its leadership in the marketplace. But we would like to grow other markets at a higher pace, even, so that we really diversify our business and decrease a little bit the reliance on Saudi as a key market. And this slide, in real practical way, really show firsthand that we are delivering on our commitments when it comes to strategy execution. So from a category perspective, you see ophthalmology and dermatology on the left-hand side growing very strongly at 27%, 28% respectively, derma and ophtha, while you have other categories like the anti-diabetic, like the pain and inflammation and others, are really growing at a stronger pace. When it comes to market by market, you see Saudi growing at a very solid 17% growth in the first half, while Gulf 21%, Iraq 44%, North Africa 21%, and Egypt 79%. So real delivering on our strategic directions and excellence in executions from every team member. I'm very pleased with how they are driving the market and really translating the strategy into actions in the marketplace. Next slide. Yeah, that's another slide that show you in perhaps a more complementing manner, focusing on the inception market, which is Saudi Arabia, how we perform against the key peers. And this is a slide that I started to show you in the last earning call, and we'll continue to give you the progress. So last earning call, I showed you perhaps 24 months business progression on the top 5 players in the Saudi market or retail market. And obviously, Jamjoom Pharma is the only name I share here, but the others, we call it peers, so that we don't disclose any data that we are not in a position to disclose about any. But you can obviously predict who are the other 4 top contenders in the marketplace over the last few years. So basically, what this slide, to refresh your memory, try to reflect to you is month on month. So every small bit of every graph of this, like in Jamjoom Pharma, for example, you have 29 months reflected here. And we show you in green if the growth of the particular months is higher than the same months of the previous year. In red, if the growth of the particular months is lower than the same months in the previous year. And simply, you can see that over 29 months, Jamjoom Pharma has shown only 1 negative month and 28 positive ones. And you can see the same tracking on the other peers, between 6 to almost 13 negative months on everyone else. Why am I sharing this slide with you, and why I feel very proud of what our team in Saudi is driving here? Because quite honestly, you can get results that is like 1 year on, 1 year off. Some companies will show you, okay, they are doing 1 year off, and then they come the following year and they do a good year, and the other year is not. Here you see almost 3 years sustainable performance. But also what does that show is the excellence and execution of the Jamjoom Pharma team compared to other peers. It's difficult enough that you deliver gross quarter, existing quarter versus the equivalent quarter of the previous year. But to continue to drive months on months for 29 months, and you continue to grow the business, and you show healthy growth like this, it shows really the excellence and execution. And this is the name of the game for business sustainability of any pharma company, because even if you don't have, and which is not the case with Jamjoom, even if you don't have 100% compelling strategy, you complement this with 100% excellence and execution, and then you win in the marketplace. What we have at Jamjoom Pharma is that we have a very strong compelling strategy, and we are complementing it with better execution and excellence in execution than our other peers. That's why I'm very pleased with this slide. Next slide, please. No, if we go back, sorry, Mohammed, to the previous slide, because yes. So what I wanted to share with the audience as well is, if you look at the bottom right hand side of the slide, you can see that year on year, 2022 onwards, up to the May 2024. This is external market data, IQVIA data, market growth, and then our Jamjoom Pharma growth and Jamjoom Pharma share. And you can see that year on year, Jamjoom Pharma has exceeded market growth continuously, and the share has continued to grow tremendously as well. So this as well really is a very strong reflection on how we are driving consistent growth in the marketplace. Next slide. Yeah. Again, we continue to show you progress on this. Again, this is executing on our strategy, whereby we said ophthalmology and dermatology will continue to grow at a very strong pace to solidify and reinforce the leadership that we have in these two categories. But perhaps other categories will grow at a higher pace, so that the contribution of Ophtha and Derma will decrease out of our total portfolio. And here you see it in action. Between 2021 and the first half of 2024, ophthalmology and dermatology, while still growing at 27 and 28% year on year respectively, you can see that their share of the pie is decreasing from 55% to 46%. Others that are starting to contribute heavily and more significantly is like consumer health. It used to constitute only 10% of the business in 2021. Today, at the first half, it's 13% of our total business. Our general medicine used to be 13%, and it's today 16%. So the diversification that is happening there, in addition of 2% of anti-diabetic that is added this year into our business contribution. So I'm very pleased with this diversification and ability to continue to grow tremendously every category and diversifying the business, so that we can guarantee the healthy growth, sustainability of the business. Next slide. Yeah, with this, I will perhaps pass the floor to Anwar Mohideen, the CFO of Jamjoom Pharma, to take you through some financial highlights. Anwar?
Thank you, Dr. Tariq. Assalamu alaikum and good afternoon, everyone. Thank you for joining us today for our earnings call. We appreciate your time as we review our financial highlights for the second quarter 2024. I am pleased to report that we have achieved positive results during the first half of 2024. Looking closely at the second quarter, our revenue was 346 million, representing a 16% growth year on year compared to quarter 2 2023. This growth reflects our strong sales volume in our core therapeutic area of ophthalmology, dermatology, complemented by excellent performance in the cardiovascular, pain and inflammation, and anti-diabetes area. Geographically, I'm pleased to report good growth across all our key markets, such as Gulf, Iraq, Egypt, and Morocco in particular, delivering outstanding above-market growth. Economies of scale from our revenue growth, along with operational efficiencies and cost control measures, grew EBITDA by 18% year on year, translating into EBITDA margin of nearly 34% this quarter. Free cash flow grew by 11% year on year, while free cash flow conversion reached 87% in quarter 2 2024, comparable with quarter 2 2023. This shows our strong financial health. Our net profit also grew by 24% year on year, with a net profit margin of 31%, which is the highest quarterly margin since 2019, and underscores our strategic efforts to enhance profitability across the organization. On the next slide, we will discuss our production cost and operating expenses and how we address cost inflation to preserve our margin. We remain committed to cost control and operating excellence to maintain superior profitability and returns as we continue to scale our business and expand our market share. Cost of revenue increased by 31% year on year in first half 2024, mainly driven by a 34% increase in raw material expenses due to product and market mix, and increase in the freight expenses. Salaries and employee-related costs grew 22% year on year due to hiring additional staff for our new facilities in Jeddah and Egypt. Depreciation expenses also increased by 51% year on year due to an impact of 2 new facilities in Jeddah and Egypt. Other costs grew 18% year-on-year due to routine operating costs associated with production activities. Production costs were offset by continued efficiency gain in operating expenses that grew only 11% year-on-year in the first half of 2024. Selling and distribution expenses increased by 18% year-on-year to reach 182 million in first half 2024, thereby reducing as percentage of revenue. The improvement was driven by cost optimization in distribution processes, more effective sale efforts, and economies of scale that offset increased in other expenses and promotional activities. General and admin expenses declined by 11% year-on-year, reaching 31 million, reflecting reclassification of Egypt facilities pre-operating expenses that were part of G&A before, and now it shift to cost of revenue upon commencement of full production, in addition to cost saving in various expenses. Research and development expenses also decreased by 9% year-on-year to 16 million in first half 2024 due to a strategic focus on the highest quality launches. All in all, non-production operating and R&D expenses grew only 11% in first half 2024. Looking at the direct production cost per unit, it stood at Saudi Riyal 3.2 per unit this quarter and reflect a stable trend with compared to similar quarters in 2022 and 2023. This stability is a testament to our efficient cost management practices, stringent cost control over expenses, and optimization of our production process. Moving to the next slide, where we focus on our margin. Next slide. So, Jamjoom Pharma continued to generate industry-leading margins and returns. In the first half 2024, EBITDA margin expanded by 1.5% year-on-year to 34.7% in first half 2024, which is well above our mid-term guidance range of 30 to 31.5%. Our EBITDA grew 27% year-on-year in first half 2024, well ahead of revenue growth and despite an increase in cost owing to a ramp-up of production. This was achieved due to operational efficiency, effective cost control management in G&A expenditure, strengthened sales and marketing efforts, driving higher revenue and better margins. On the right-hand side of the slide, you will see an evolution of both EBITDA and net profit margins during the last 5 quarters, which demonstrate the upward trajectory of our margins. We will move to cash conversion cycle on the next slide. We are pleased to report that our cash conversion cycle remains stable despite business expansion, while we continue to build inventory reserves to meet future demand and effectively navigate potential supply chain disruption. We balance increased inventory days with lower receivable days and higher payable days. This is made possible through stringent credit management and strong relationship with our suppliers. Our working capital is up by 17.5% year-on-year to 663 million, staying below our 22% growth in revenue. In terms of cash balance, I am pleased to say that post recent dividend payout, our cash balance remains stable at 156 million at the end of June, and we have also announced a dividend payout of 112 million for the first half of 2024, which is due to be paid in this month. Overall, we maintain balanced approach to working capital management to keep track of a stable cash conversion cycle and ongoing business expansion. With this, I would like to hand over to Dr. Tariq for future outlook and guidance.
Thank you, Anwar. So, moving into next slide so that we can share with you the update on our guidance. So, if you remember, we shared with you earlier in the year that our revenue growth will stand not only for 2024 but up to the end of 2026 at a rate of 12 to 15% year-on-year. Given the very solid positive 6 months of 2024, we are updating and upgrading our revenue growth expectation to 15 to 18% instead of 12 to 15. So that's the update on the revenue. On the EBITDA margin, we always mentioned that we'll have between 2024 and 2026 an EBITDA margin of 30%. with a possibility of 100 to 150 percentage point on the top. Now we are updating the EBITDA margin to be 31 to 32.5%, given where we track year to date almost at 35%. CapEx will remain at a 4 to 6% out of the top line, and our dividend basically we are committed for the 50 to 60% payout ratio on a semi-annual basis, twice a year. And as mentioned, we have already announced that within this month we'll pay the first portion of it, which is coming close to 112 million out of the profit we have for the first 6 months. With this, I will pause and will invite any comments or questions from your side.
Thank you, Dr. Tariq and Mr. Anwar, for the insights. We open the floor for the Q&A session. Just general instructions. Please limit yourself to 2 questions. And to ask a question, you can click on the hand raise button or use the chat box to post your question. First question is from the line of Tariq. Tariq, please go ahead.
Afternoon, can you hear me?
Yes, Tariq.
Okay, perfect. So thank you so much for the time to ask questions, and congrats on a very solid set of results. We're getting used to those now. So my first question, I guess, is we've seen that you're gaining market share, given that you're outpacing the market significantly. And you've shown a very helpful slide, which shows that even some competitors have seen growth Q on Q. So it looks like the local players are gaining market share, and you are one of the leading in gaining market share. Do you see a momentum into the medium term continuing at the same pace, or you're accelerating the growth currently and taking from the growth into the medium term? What I mean by that is are there such underpenetrated significant therapeutic areas where you still can take market share from whoever you're taking? So my question summarizes in who are you taking market share from, and how long can you keep on benefiting from this momentum? Second question is on the reason behind the drop in CNS. We've seen it in Q1 and into Q2. And GTI, please. Is it because of any tender where the prices are lower or something like that? I'll come back in the queue because I have more questions.
Okay, Tariq, thank you for the question. I'm happy for you to get used to it, but I alert you against taking us for granted for these results, because this results doesn't come that easy. I hope you and everyone else realize it takes a lot of sweat and a lot of planning behind. But pleased to continue to deliver and announce to you one good set of results after the other. Basically, yes, you're not spot on. The whole market is actually positively trending, especially in Saudi, but actually in other markets like Gulf and Iraq as well. We're trending better, but don't forget, it's not only the local players, Tariq, that are doing this. I just gave you a quick brief during my presentation that one company in particular is taking everyone by surprise and jumping into #1 in certain months so far in the year, just because of one product, type 2 diabetic, basically that can help with weight loss, to be more specific. So this is contributing to almost half of the market growth that we are witnessing in Saudi year to date. So that this is a key dynamic, actually, more than the fact that local players are trending positively. And we take this to the heart and mind. Obviously, that lifestyle products are there to stay, and they are going to contribute from now on heavily into driving the market growth. Basically, our competition, which is the main part of your question, we view the whole market as our competitors. We don't really look at just generics or branded generics as our competitors. Otherwise, we'll really narrow our spectrum and we will not grow as tremendous as we do. But every single player in the marketplace is our competition. Don't forget, on the consumer health side as well. These are not typically tracking as branded generic products or whatever. As a matter of fact, you don't classify consumer health as such. So we are leading in this trend, and this business is starting to really contribute heavily, as I told you and showed you that in the first 6 months, it's almost 13% of our business, total business delivering. So out of these 731 million that we delivered, 13% out of this contributes only to consumer health, and 96% out of this is in Saudi Arabia market alone. So the total market basically is our green field in terms of competition. We compete with everyone who has a similar product, focusing on definitely the leading ones. And we try to take share out of this. We try to catch up with the tender and the institution business, as I shared with you as well, because it's a tremendous opportunity for us. I shared with you how we are tracking on Wasfati. We are doing well, and others are doing well as well, and we try to lead in this place. CCHI or insurance, we try as well to further strengthen our dialogue with the regulators on this front, so that we can gain whenever there is an opportunity to gain on this front, and put Jamjoom Pharma at the front line of choice when it comes to branded generic products in this field. So basically that is where we are driving our growth today from. Is it going to be more difficult as we move on? Definitely it will, but I don't think we're out of tricks when it comes to how can we drive further growth in the marketplace over the quarters and years to come. Be it sectors that we are still not represented as well as we would like at, new products, the likes of anti-diabetics that we have just launched 2 or 3, and we have others to launch in this field. Increased capacity, as I shared with you, the new sterile facility that will really enable us. Don't forget, I told you that my easy assumption is that almost 1/3 of what we generated in terms of demands over the last couple of years on the ophthalmic side, we lost it because of our constrained capacity. Hopefully, the new sterile facility, which is going to be fully operational, up and running, with many products commercially approved by the beginning of 2025 or later on this year, this will contribute heavily into driving our business momentum and growth as well. So we are not only optimistic and happy with where we track today, but I'm still equally optimistic about the future, Tarek, especially when I see that not only Saudi is pitching in as it always used to be for us, but every other single market is really starting to contribute more heavily to our portfolio with tremendous growth. So this gives me trust in the near and the midterm future, inshallah. Thank you for the question.
Thank you for the detailed explanation. Next question is from the line of Ibrahim. Ibrahim, please unmute yourself.
Congrats, Dr. Tariq and Jamjoom management for those great results. A couple of questions from my side. The first one is on the public market. Can you shed some light on the public market? As we heard from you that there was a slowdown during Q1. Is this also applicable to Q2 because you are showing an 18% growth in the tender business overall? The second question, and this is a follow-up question actually, is Wasfati part of the tender business, near calculation of the tender business or not? Thank you.
No, I mean, so the answer for the second question is a simple no. It used to, when it was first launched, for ease of classifying, it was added into the institution and tender business, but now it's more part of the retail business, or the basically because you dispense all the medications out of retail pharmacies. So this is the more sensible way of calculating its sales. Also, it's still moderated and to a big part managed by NOPCO, which is more on the institution and tender side, but most of the dispensing is coming from retail pharmacies. Hence, it's part of the retail. Public sector still track well for us and others. We are doing, but don't forget, there will be always a periodic time because the delivery months on months of the awarded tender vary between one company into another and sometimes even if we have certain deliveries on a given month, but our supply is not giving us enough products to be able to satisfy post-tender and retail, and we have to make some choices. We defer some of the delivering into the months after and the months after. So this variation that you see are not actual variation in terms of dispensing or in terms of the actual demand, but sometimes it's based on the awarded tender agreed time of delivering and as well our ability to supply on time. But so far, we are still very positive about the tender and the institutional business, its impact in the overall marketplace in terms of growth and its impact, expected impact on our business in specific.
So the new tender has not kicked in yet, right?
Say again?
The new tender has not kicked in yet.
Not yet. Yes, you're right. You're right. Yeah, the previous one was supposed to be for 2 years. It was extended for a third year. The new one, we just got the full awardation a month or two ago, and we expect the kick off by September, October this year.
Excellent. Thank you so much. I'll go back in the queue.
Thank you. Next question is from the line of Sarah. Sarah, please go ahead.
Sarah, thank you, management. If you could please shed light on the below EBIT number. We've seen a similar numbers in Q1 2024, and this was mainly attributed to the Egyptian currency devaluation. So I just really wanted to understand: is it the same issue, or is there anything new?
On what? Sorry, I didn't get your question exactly.
On the below EBIT figure.
On the new EBITDA figure?
Below EBIT figure.
Okay. Anwar,
on the devaluation?
Yes.
Devaluation of Egypt?
Yes.
For the time being, it is stable. That okay, we are not expecting, or we have not, see any devaluation. So far, it is stable for the moment.
Yes, I understand, but we could see that there is a 20 million loss in other expenses. So if you could please shed light on this number.
It is the same carry forward from 17. I mean, YTD it is there, right? So 17 million is related to the exchange devaluation coming from the first quarter.
So Sarah, simply, the impact of devaluation is not limited in Egypt because it gets a little bit complicated. It's not limited only to the direct impact of the price per product or the dollar exchange into Egyptian pound straightforward once we sell a pack. But another impact that we faced this year is the fact that, simple fact, we were sitting on, like, for example, not the accurate number, but I'm giving you for the sake of better explanation. Let's say we were sitting on 50 million Egyptian pound last year in Egypt. Now, the ideal thing is we would have left only a percentage or a portion of this for our operating expenses and other working capital, and other money we will repatriate to Saudi based on the dollar equivalent by that time. We couldn't, simply because there was no enough hard currency. So we were not able to repatriate this money. Okay, come this year, further devaluation, so this money became of less value than how it used to be for us last year. So that's why we accumulated the impact in the first quarter, and it gets less quarter by quarter as you see. So that's basically another impact that we will hit with as an indirect impact of the devaluation that took place last year and earlier on this year. what I want to remind you and remind everyone is that despite this, and this is where I need to give some credit to my leadership team and the team behind the result I shared with you, despite all these impacts that some of it takes us by surprise, and it's to a great extent out of your control. These teams continue to deliver some of our best results in terms of margins and in terms of EBITDA and the net profits and whatever. Not only because of limiting the impact of these kind of things, but as well increasing the efficiency on other fronts and reducing cost on other certain fronts, so that net we deliver the results that you are seeing. So and it helps, of course, and I remind everyone so that we don't really get in the mood again of 100 questions on Egypt. Egypt is still 5% of our business. So in the big picture, in the big scale of it, we don't have a huge magnitude of whatever impact we get out of there, and it's always manageable for us.
Thank you, Dr. Tariq.
Sure.
Next question is from the line of Sultan. Sultan, please unmute yourself and ask your question.
First of all, congratulations on your strong set of results. I have just two questions. The first question is, when we look at Saudi growth, in the second quarter, the growth dropped to around 9%, which is in line with the market. And if we look at the first quarter, you were growing at double digits, early 20s. Why did your growth decline in the Saudi market in the second quarter?
Yeah, so thank you for the question. So it's you cannot look at this as a separate piece of data. You need to compare this with our second quarter, because the way we forecast our business and we split our target or budget is that we do it month by month and quarter by quarter. So every quarter we have a quarterly budget that we measure ourselves against. So the first thing that we measure ourselves against is how did we phase the year for us. So when you look at the second quarter, yeah, everything you said is right, but the key thing for us is that we met or exceeded the quarter target that was set for us, and rightly so, because when we set the target earlier in the year, so we take into account many things. How we are starting the year, for example, because remember, I always explain to you guys, if you were one of our business partners that attend every earning call, I always exhausted the explanation of the two things that go in parallel for us: the in-market, which is our sales into the marketplace, and the to-market, which is our sales from the plants into our distributors that can sit on the shelf of distributor forever. What we are discussing here is our sales from our plants into our distributors, which we basically understand how we are going to close 2023, how the first quarter will evolve in terms of ramping up the stocking on the distributor side, so that they can meet or exceed whatever is needed for the future months. And then we phase our budget accordingly. So quarter one was high because of the starting at a low stock level at some distributors that contribute majorly to our business. And then once we did this ramping up, then the growth will go back, as you said correctly, into meeting the market or whatever. But that's not the real one that we always track ourselves against in isolation. We look at our in-market sales as well, and we track this, and we see how we are performing based on our set budget. So we look at the two hand in hand. We don't look at one in isolation. That's the first thing. And the second thing, we do the phasing quarter by quarter, and we measure ourselves not only against the market growth, but against our delivering on the quarter results. And in this case, we delivered on the quarter results above 100.
Great. And the second question is related to the toll manufacturing. Which you mentioned that it is going to be across all your facilities in Saudi and Egypt, if I'm not mistaken, right?
What's that? Sorry.
You are going to produce these products in facilities in Saudi Arabia and Egypt, right?
Which products?
The toll manufacturing.
The what?
The toll manufacturing.
The toll, yes, the negotiation that we are having with some multinationals to have some toll manufacturing agreement.
Yeah, but my question here is that why are you taking this direction? Are you seeing slower growth in this year?
No,
that you're shifting to toll manufacturing or what?
No, I explained. I think last earning call. So in Saudi, for example, remember until few months ago, we were relying on the Saudi main facility and the only facility we had by then to supply all our markets. End of this year, beginning of 2025, we will have another 3 facilities up and running, helping this facility. So this will reduce some of the pressure on this facility and will release some of the existing capacity ability, so which we can utilize for things like toll manufacturing agreement. Because don't forget, when you do this kind of things with big pharma, big multinationals, and whatever, it's not only for the sake of margin or capacity utilization, but as well you learn from different manufacturing ways. You add to the credibility of your organization and what you are delivering in the marketplace. So it has more strategic factor rather than just getting few pennies out of the margin here and there. So in Saudi Arabia, the capacity we are freeing. Don't forget, I always reminded the audience that while Egypt represents only 5-6% of our value numbers, it represents almost 15%, 1/5 of the unit sales. So if you relieve this 15% or big part of it out of the existing facility, that's a lot. 15% out of 150 million, you are talking about more than 22 million you are releasing. So you are going to utilize this in combination of satisfying all the other expansion in key markets out of your own products, and as well if you have the capacity on certain lines and the certain products to get into these partnership deals, that's beneficial for our team and for our business as well. In Egypt, it's the same. Today you are producing almost 10 million, which is satisfying 60% of the local organization needs. And the planned capacity is about 52 million. Until you ramp this capacity fully, you can utilize some of the free capacity and you can maximize the learning of your team as well by getting into other lines and manufacturing for others. So that's for us. This is more strategic than just doing it for an extra margin here and there. It's good to get into such partnership to maximize your team learning and to advance with certain things that perhaps you will not do if you don't get into such partners.
Great, thank you, Mr. Tariq. Just a very small last question, if I may, which is related to the operating expenses.
Yeah.
In the second quarter, if I compare it to the first quarter, we saw the operating expense roughly decline by around 9 million. Why was that? What was the main reason for the decline, Q and Q?
Yeah, correct. Anwar, would you like to give a quick preview?
One is that, okay, I explained that, okay, there are, if you're talking about from the previous year or you're talking about from previous quarter?
No.
Quarter
second
to
quarter.
Quarter.
Yeah.
Second to first. 9 million decline in our OPEX.
So mainly that, okay, because of certain expenses which we are controlling, and some are related to the sales also. If the sales, varies about the sale, but mainly that, okay, we are, controlling some of the expenses in major part, admin, G&A also, and then our selling and marketing expenses also.
Again, so we don't face only our top line. We face everything that is part of our P&L line by line throughout the year. So one quarter will be higher sales, one quarter will be delivering just on the quarter commitments, so slightly lower sales, but as well, lower sales will be matched by lower OPEX, because operating expense is a key product of how much sales you do. If you are not selling as much, you don't need to spend as much. So we define every line of our P&L based on the quarter phasing and the dynamics that we know in the market, and where we are going to spend this or where we are not going to be in need to spend this. Like, for example, when we build on raw materials, strategic raw material inventory, we do it in a month or a quarter, which might inflate a quarter OPEX. But then come the next quarter, and it will look like we spend less. Actually, if you normalize the two quarters together, it will be almost equivalent. It's the fact that we bought certain materials in advance. So this is how we manage our P&L, more or less.
Okay, thank you, Mr. Tariq, and wish you all the best, inshallah.
Thank you very much.
Before we take follow-up questions, there are a few questions in the chat box. I'll read that out. First one is about volume and price. What was the contribution of volume and price in revenues in Q2?
What? 40, what's 42, sorry?
Yeah, how much of the growth was driven by volume and price in Q2?
In Q2, it's mostly almost all volume. We don't have a price increase except in 5% of our business that just happened a few days ago, that didn't even materialize, which is in Egypt, as we mentioned in the presentation. But all the price increases has happened last year. The major part of it, 40 million, as we shared with you in full transparency, was a positive outcome of price increase last year. Khalas, it's built into our plan this year. So it's majorly volume up to the 98-99%.
Clear. About market share, you have already covered. So third question is about utilization level for new facilities. When do you expect the ramp up to be completed for
Which one? Because we have
Jeddah
two
Sterile
new
and Egypt, both.
The new trial and Egypt. Okay. So the new trial, as I told you, not the full ramp up, but our expectation, what we have built in our plans, is that come December 2024, the local facility will contribute into 70-75% of the sales of the local operation, Egypt. And that's roughly will contribute into, give or take, something within the range of perhaps 25 million, 26 million, which is 50% of the theoretical capacity on paper today. Because until we see it and until we do it, it will remain to be just on paper capacity, the 52 million that you have seen. So end of this year, we will come into almost 50-55% of the full capacity utilization. Come next year, we will perhaps adhere to an almost 80%, and perhaps on certain lines, end of next year, it will come almost to 100%. So we need to have some expansion plans for certain lines as early as end of 2025 for Egypt. For the new trial facility in Jeddah, this is a smaller, more specialized unit, as we always shared with you guys. It's going to focus on ophthalmic and some injectables. Perhaps the theoretical capacity is 25 million. We expect equal 75-80% capacity utilization or ramping up before the end of 2025. And this ramp up of the new trial facility will take even a faster pace than the one in Egypt, because the demand is there, and the products that are hardly in need of us producing more, because to satisfy certain market requests are already there. So it depends on the efficiency and the effectiveness of our team to ramp up this facility sooner than later. And I have full confidence that we'll be able to meet the forecasted 75-80% ramping up of this new sterile facility before the end of 2025.
Sure. Do you
Thank you.
have time for one more question? As I can see hands being raised, but we haven't, given them the opportunity.
Maybe we'll entertain some other people and we'll come back to you if we still have time, if you don't mind.
Yeah, so there is one question. So we have a couple of, questions, hands being raised.
I'm good with this. I'm good with this.
Okay. So next question we would take from the line of Athman Capital.
For your impressive presence. I have one question about this market. Do you have any strategic plans to neutralize the bad effect of the Egyptian market effects? I know it's a very small portion of your results. It's around 5%, as you mentioned, but it is still 15% of your production. So do you have any plans for neutralizing it even very Egyptian market?
Yeah, I'm sorry. I'll attempt to answer what I thought I heard because your voice came up very interrupted and not clear. But what I thought I heard is that your question is about, do we have any strategic levers or plans to offset the impact of any further forex impact on the Egyptian front, even though it's small part of our value generation, but you're alluding to the fact that it's 10-15% of the unit generation. Did I hear you properly?
Exactly.
Okay. So basically, I shared with you openly during the presentation that we continue to have healthy dialogues with the authority to get some price increases because it's it's a very skewed equation, quite honestly, when you see that, for example, if the Egyptian pound decline in front of dollar by 20% on the same day or the following morning, you will get into the supermarket and find that every single essential product has inflated their price by 20% or more. When it comes to medicine, it's the other way around. Why? We understand this is the nature of the beast because it's a very sensitive political commodity for the government. It's like the bread and other stuff. Although lately they have moved on the bread finally, which is a good sign because they cannot afford to continue to fund this. So we continue to have dialogues with the government to have price increases, and I'm pleased with what we have achieved. My team have achieved on the ground on the last few months because we managed to get some good price increase for some of our key products. And I thank the regulators as well for their understanding and response. That will partly offset the whole thing. Another part that add insult to injury, as we were explaining during some of the questions, is the availability of the hard currency. If the government continue to drive, because quite honestly, we don't mind whether the pound will land at 47 or 50 or 60 or slightly above or slightly lower. What we mind, because this is what adds a hell of insult to injury, is the lack of hard currency availability, because that impacts our ability to get on timely basis our needs from a raw material and whatever that we need for manufacturing. But more importantly, it doesn't enable us to repatriate our money or to take our money out of whatever is not needed in the market to bring it into the inception market, Saudi, and we try to offset the impact of sleeping on this money and further devaluation happen and decrease its value. As long as the hard currency availability is going to be there, this will minimize any impact. And as I told you, we learned this year the hard way from what happened last year. So we went last year with a budget assuming that the Egyptian currency will be at a much higher rate than what it landed on into the dollar. So we had a bigger impact. This year, we went with actually 45 Egyptian pound to the dollar in our forecast, and we were almost spot on, because today we track at something between the 46 to 49. So we are very, very close. So if we continue to forecast this properly, I think this will enable us to really build our budget on realistic assumptions, not just a blue sky scenario assumption. And if the government continue to avail the hard currency, this will minimize any further impact that will happen on us. Out of this, quite honestly, anything else will be out of control, not only us, but for every other company. But if history was a good predictor of the future, I think what happened in 2017 and what's happening now, things are going more on the positive front. Hard currency is much more available than a few months ago. The currency is stabilizing, hopefully, and even if it goes sideways, we expect that the availability of the hard currency will minimize the full impact on us. So that's our plan, more or less.
Thank you. We'll be taking a last question from the line of Taha. Taha, please unmute yourself and go ahead.
Great results as always. So just a small follow understanding wise, obviously year-on-year growth is very good in 2Q, but can you explain what the seasonality is for revenue wise? Why 2Q is usually lower compared to first Q, which products suffer on this front, and a bit of color if you can provide on the Iraq market, like what kind of a market do you see its potential, and what kind of a market share do you have in Iraq?
Yeah, sure.
Thank you.
So, yeah, seasonality is, as I said, we take this into the phasing. And seasonality doesn't mean only the fact that, like, for example, in Saudi and the Gulf, come July, August, and you find a big portion of the population disappear and go for vacation for other areas. Because actually, even this, to be honest with you, is a bit changing. So in the Gulf, with the marketing efforts that the United Arab Emirates government is doing, and spending the summer in Dubai and other areas and whatever, the impact is becoming less. In Saudi as well, they started this year, early days, but we'll see as well. I expect that the momentum will slightly improve in terms of the people who will stay back in the home country and spend their summer in the more available areas in the country. Having said that, seasonality doesn't mean only for us but sometimes certain products, for example, like the anti-infectives or the antibiotics, obviously come September, October up to January, February, this is a big season. Of course, it becomes, or it lessens in other months, and the same for other products. Now, we basically, as I told you earlier, phase our quarter on quarter and month on month expectation in sales based on our understanding of this seasonality, product by product, market by market, month by month, and so it's more a little bit complicated than I can explain in a couple of statements for you, and I just try to limit the seasonality into the summer months or the winter months or this and that. It takes much more than this when it comes to our business when we look at seasonality. Iraq is a market that we are very bullish about. We're positive about it. Like every other market in the region, it basically has the particularities of the marketplace, where the local regulators are looking more and more for companies that are going to localize its business activities, so that they continue to enable them to earn and to gain share in the marketplace. So we expect this to come over the coming few years, because the governments have already started to push into this direction. And we have certain plans into how can we fulfill this and continue to win in this very important marketplace. At the moment, most of our sales in Iraq are ophthalmic units. It contributes almost to 70% of our sales in Iraq. Hence, my expectation for the growth in this market is really positive, because once we complete the portfolio and we bring other products from other categories, then I think the sky is the limit to how far can we grow, because the image we have built as an organization, thanks to the local team in Iraq, is really one of the best images that we have across the region. So in physicians and patients, heart and mind, Jamjoom Pharma come really as top of mind thinking when they think of high quality, affordable prices. And this is exactly where we would like to place ourselves in a market like this. So I continue to be very bullish about this market and how far we can grow in this market if we continue to satisfy basically the local needs and become attentive of what would it take to win in this marketplace, like any other market.
Thank you. So that was our last question. Back to you,
Sure.
Dr. Tariq, for any closing remarks, and after that we can end the call.
Sure.
So if you have any closing remarks, you can share those, or else we can end the call, Dr. Tariq.
Okay, so yeah, as always, I really thank you for the interactive session, and I'm always pleased that we take 30 plus minutes in the presentation, but we take much more in the Q&A, which show the understanding and the positive interactions that you guys contribute to the call. Pleased to continue to deliver positive news for you. Hopefully, we can continue to do this over the coming few quarters and years, and we rely on your support. If you see anything that is screaming on you from an improvement point of view in our business, just let us know through an email or by contacting the right people, like the head of investor relation or other partners, and then you'll find us very attentive to this. But I assure you that Jamjoom Pharma will continue to really meet and exceed expectations, and we are very bullish about the future of this business in all our active markets, and we thank you for your continuous support. Have a great day all.
Thank you, Jamjoom's management and the participants. With this, we end the call. Have a good day ahead. Thank you, everyone.